Arbitrage strategy is a trading technique used by investors to take advantage of the price differences in different markets. It involves buying and selling assets at different prices in order to make a profit. This strategy can be used in stocks, currencies, commodities, and other financial instruments. By exploiting the price discrepancies between two or more markets, arbitrage traders are able to generate profits without taking on additional risk. For example, if an investor buys a stock for $50 in one market and sells it for $60 in another market, they have made a profit of $10 without taking on any additional risk. This type of trading is often done with the help of computer algorithms that can quickly identify and act on opportunities for arbitrage trading. With examples from real-world scenarios, this article will explore how arbitrage strategies work and why they are so popular among investors. Arbitrage is a popular trading strategy that involves taking advantage of price discrepancies in different markets. It is a risk-free way to make money by buying and selling securities simultaneously in different markets. The goal of arbitrage is to take advantage of the differences in prices between two or more markets. By buying low and selling high, traders can make profits without taking on any risk. With examples, we can illustrate how arbitrage works and the types of strategies that traders use to make money from these price discrepancies.